We are going to talk about what happens when a bond matures. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Grant Sullivan.
And we're happy to have you along. Hey, if you wonder why I'm saying good morning and you're watching this on Tuesday evening, we do stream it live on Tuesday evenings from 5 to 6 p.m. We do have it on our website at yourlifeafterwork.com. We do have it where you can watch it on our Facebook page at Financial Enhancement Group, the Tidbits, Financial Tidbits page. But we're also on multiple radio stations. Now, if you're on WIBC, you only get to hear 3 of the important things that we talk about. So if you want more, you're going to have to find us on one of the other sources. Happy to have that along. We are going to talk about what happens when a bond matures. Notice I didn't say mature. I am a Hoosier. It's easy for me to say that. But no, seriously, Andy, you want the tagline of what we want to talk about. One of the reasons that Wall Street loves bonds is that they mature, they die, they run out of air, and then you have to redo something with capital. Stocks, that doesn't happen, right? And so the Wall Street, about 68 to 70% of the market is actually driven by bonds, Grant. And a lot of people don't know that. Mm-hmm. They would think the stock market is larger. It's not. At one point in time in my career, the bond market was about 6 times larger than the equity market. Today, that's not quite the case. But it's still very, 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 very large. And bonds mature, they die, and then you have to have capital that is replenished. So why don't you walk us through the lifespan of a bond? What happens?
So an organization, an entity, a government needs to raise capital. And essentially they go out to their, again, if it's government to a certain branch, or they go out to, again, an entity and they raise capital through offering a bond. So instead of giving out ownership through a stock, they go out and offer a bond that they're going to pay back over time. So they're giving you the principal you put in, but throughout that time, they're going to also include coupons. And something Joe said very, very early on in my education at Purdue was that bonds don't pay interest. They pay coupons. And that's something that's really important to understand because that coupon comes in most likely semi-annually, sometimes quarterly or annually. And then what happens is once that bond is issued, it goes to open market. People can buy that depending on the type of bond, corporate, government, etc. There's certain tax benefits to that, etc. And then essentially you own that bond until maturity. I have a hard time saying maturity. I'm a Hoosier too, Joe. That's embarrassing. And then at that point, you're given back your principal and whatever coupons you're given as promissory from the issuing of that bond.
So the coupons, as I like to call it for Randy White, if you're not I love comedians, the coupons are actually paid. They don't accumulate. So the biggest difference between a bond and a CD is many times the dividend that's paid to your CD, certificate of deposit, if you keep money in a bank, is actually accumulated. It's why your annual percentage rate or yield can actually be higher than what the interest rate is that's credited. It's because you have compounding money. In a bond, that doesn't occur. All right. So if you look at the screen right now, and again, I know most of you can't see this that are listening on the radio, but what we effectively have today is a 10%, 12%, 22%, on up all the way to a 30%, 37% rather, marginal tax bracket. So the best way to think about our tax code, Grant, is to think about a series of stair steps. Now, what happens inside of the bond arena is they really don't care who gives them the money to build a bridge. They really don't care who gives them the money to finance the corporate buyback that they want. They're looking for the majority of the most amount of capital they can get. And my only point of telling you this is they're not typically looking, when I say they, the companies that are issuing the bonds, whether that be a municipality or not, are really not interested in the lower tax brackets. What they're interested in are the people who have all of the cash. right? They're typically interested in people who can write big checks, not small checks, because all they want to do is get their project funded, whether that's buying back stock if they're a corporate, or whether they're building a bridge if it's a municipality, or building a library, what have you. And so what happens is they take those top tax brackets, if you will, and they look at the rate that they would have to pay if you were based on a regular individual with a similar amount of credit quality. So think about credit scores that you guys have as individuals. It's no different. Municipalities have those credit scores. Corporations have those credit scores. They talk about A, B, and a bunch of BBBs and AAAs. But it's still a credit score, no different than our 715 or our 815 or wherever you happen to be. But they take those numbers and then they look to see what they have to pay if you could deduct the money in the open environment versus paying taxes on the open environment. And then they come up with a rate where if you're in the top taxpayer bracket, it probably behooves you to buy a municipal bond. And here's where Joe gets frustrated. This is where the feathers start to ruffle, right? Nobody likes taxes. I don't like taxes. You don't like taxes. If you're listening to this program and you like taxes, you're probably listening to the wrong show, right? It's just who we are, right? We all know that bridges need to be built, militaries need to be developed. We all get that, and I'm more than happy to do my part. That doesn't mean that I like the taxes on the other part of the deal. So when we look at this structure and we understand what is out there, understand if you're at a higher tax rate, the municipal bonds were written for you to be able to buy the municipal bond where you do not have to pay marginal income tax, and you get an effective rate that is higher than if you bought a corporate bond. Now, the inverse is true if you happen to be lower. So if you're going to some brokerage firm down the street that has a green label with white letters and everybody looks alike, and you walk in there and you say, I hate taxes, and they sell you a municipal bond and you make less than $100,000 a year, and get your tax return out. If you don't know your tax return, you're making a mistake. If you ever buy a municipal bond and you can't answer the questions that I would ask in your tax return, you are making a mistake. But look at your tax return. If your adjusted gross income is less than $100,000, you're married, filing jointly, you have no business buying a municipal bond. It doesn't matter how good it sounds. It is a mistake. I'll just leave it at that.
So with that, Joe, and you're doing a wonderful way of segueing into some of the questions that we've got here and coming in. So then if that's the case, how do you know, it's not only from a tax side, but even from an investment allocation side, how do you know how much to hold in bonds? If these things mature and die, do you try to buy them at the beginning? Do you try to buy them at the end? Do you want to hold individual bonds?
That is that's really a very, very good question. 68% of bonds are never sold. They're bought with the original issuer, and they mature with the same person. And so what happens in the world we live in today, thank God for exchange-traded funds, we're able to actually buy bonds of any duration, which one would think that means the period of time. It's really not. It's the credit. It's the risk you deal with a 1% move in the bond market. But you're able to buy bonds that mature at different times in different baskets, right? And so it really depends. Well, I have never been one that said you should have a certain percentage of your money in one thing, right? So when I look at my diet, right, I've become a health freak here at 54 years old. When I look at my diet, there is a percentage of my allotment that I want in protein, I want in carbohydrates, I want in fat, right? Mm-hmm. That doesn't mean it's the truth for every day, right?
Right.
When I go on vacation, things change, right?
Yes.
And when you look at an economy, things have to change, right? So I can't tell you at 54 still running FEG and managing the firm and having an income that I have as much exposure to fixed income as I will when I'm 20 years from now, right? Things change, but you have to be able to change not just based on your own circumstance, but the economic circumstance that's out there. And we live in a crazy world right now. And if you don't understand we're in a crazy world, you need to wake up and understand we're in a crazy world.
And I'm really glad you brought that up because, again, it's when we were in college even. I'll never forget this. It's kind of a fun story about Joe, but he had come in and asked us a question about fixed income investing and bond investing. And we did exactly what a lot of families do with us. We just blankly stared at him. Because what you guys, when looking at this, one of my favorite expressions that Joe taught in school, and I think we even still tell families today, is interest rates play a big part in that ever-changing environment. And interest rates are like a teeter-totter. And when they go up, bond prices go down and vice versa.
Value of existing bonds go down.
Correct. And so with that, like Joe said, if you're going to hold on to something like a bond until it matures, but you're not going to be cautious of what's going on around you, it can be dangerous. And so especially with where you're at in your position in what you're trying to accomplish with your retirement income.
Yeah. Looks like we got a question.
We do. Cindy, can I convert my required minimum distribution from my traditional IRA to a Roth IRA? So Cindy, here's what I tell you, and very quickly, is that you want to convert your traditional IRA to your Roth when it's appropriate and after looking at your tax return with your advisor. As far as a required minimum distribution, you have to take that separately.
Absolutely. Great answer. You cannot. By the way, if it's inherited, we get this question pretty much every week.
Yes.
Once it's inherited, it is stuck with whatever was inherited. You can use your RMD, by the way, to make a contribution if you qualify. But you cannot convert the RMD. Great answer, Grant. 800-928-4001. We'll take a break and be right back.